When it comes to investing, many of us often still see investing as too risky or even gambling. But as many of you guys now know, I am a huge advocate of investing, especially when it comes to building long-term wealth. But how can we reduce the riskiness of investing? Well, today I'm joined with Neil Wilson from Saxo to discuss diversification and how you guys can diversify your portfolio. Hello, Neil. How are you?
I'm very well, thanks, Ola. Thanks for having me.
I'm very excited to have you on the podcast today, especially to chat all things investing, risk, diversification. Because again, I feel like I mentioned in the intro, a lot of people often associate investing as gambling or it being too risky. And I'm hoping you can demystify all of that today on the podcast today. But before I delve into that, please introduce yourself to everyone listening.
Sure. Well, I'm Neil Wilson. I'm the UK investor strategist for Saxo.
Yeah.
Saxo is a retail investing platform with a global presence, but I specialise in the UK market.
Brilliant. And how did you get to where you're at now?
By a lot of luck, I guess.
Surely not. Must have been a lot of hard work, yeah.
Some hard work, yeah. No, I've been in the city for over 10 years now. I started out with a retail broker and moved to another retail broker and then ended up finally at Saxo. So I've been in the role for about 6 months now.
And are you enjoying it?
I love it. Yeah, it's great.
Amazing. And before we obviously come onto the podcast today, we're talking about the importance of financial literacy and things. Why do you think it's so important that some of us actually, I guess, learn about money?
Well, I think, money's, let's be honest, it is terribly important. It's what puts the lights on and pays the bills and so on. And I think that there's not enough done about educating people about money. And I think that in terms of investing, you have a sort of gap between those who do and those who don't. And that gap widens as people get older because the value of investments tends to increase over time, with a few caveats within that. But, investing is about a long-term plan for your wealth and for your future. And you might even be investing without even knowing it if you're putting money into a pension. Yeah. That money is not sitting doing nothing. It's hopefully growing. Usually invested in stocks and shares and other assets. But it's growing. You can be investing without knowing it. But so it is important to understand it. And the more you learn about it, hopefully the more that you can make the investing actually work for you. Yeah,
I agree. And I guess, obviously, following on from that, what's one piece of financial advice you would share with your younger self?
Buy Bitcoin when it was $10. Really? No, that's a bit flippant. I in terms of financial advice, definitely to start as early as possible, because the value, the sort of compounding effect of investing matters an awful lot. So the research, just raw figures show that the longer you're in there, the more it grows, and it tends to the growth accelerates. So the way the curve works, you get that the most of your investment value will be in the last 10 years, say, of that process. So if you invest at 20 rather than 30, for example, you've just added another 10 years that can make a massive difference at the other end of your investment life.
Yeah. And I agree. And I'm glad you kind of said that, because a lot of people often reply to that question with the same thing. And I always joke that I wish I started investing the minute I walked out the womb, because I'd probably be a millionaire right now and I wouldn't have even needed Bitcoin, And so I think that's why I've got such a passion about financial literacy, especially within the world of investing, because again, I think that's where we can really build wealth rather than just putting our money in a savings account. But Neil, you work in Canary Wharf. You are pretty high up at Saxo, and so I'm really keen to know, what's one guilty pleasure you like to spend your money on?
Well, I would definitely say it's holidays, and I say it's a guilty pleasure because I think my wife sort of always like, oh, not another. Why do we, not another one? But yeah, I love getting away, so I could probably invest more and spend less on holidays. So that would be the one thing that I definitely overspend on.
I'm the exact same, and that's why I'm smiling so much, because I relate. I really relate. If I book another holiday, my mum's like, "You're gone again." Yeah. Even my followers, even my audience, they're like, "Ola, are you ever in the UK?" And I'm like, "Yeah, I am," which is why I'm always away to leave the UK sometimes. Yeah. But no, I love that because I do relate. But I guess obviously we're here to talk about investing today on the podcast and all things diversification. So I guess if anyone has never heard of the term investing before, what actually is investing?
Well, so sort of quick 101, I guess, is it's putting money into assets like stocks or bonds, which are that's how the government raises money or companies raise money, or things like real estate, or even things like fine wine, for example. There's a huge range of different things you can invest in. I think, generally speaking, people are looking at stocks. They mean stocks, really, when they're talking about investing. And it's with the hope or expectation that investment will grow over time, grow in value, and or provide an income. So for example, with stocks, companies will pay dividends, so you can get dividends back from that investment. So I guess it's saving money for the future is kind of the idea. And it's not without risk, obviously. The value of assets can go down as well as up. But I think particularly if you're thinking long term, then the history, the statistics show that the value of investments over the long haul, particularly in the stock market, as long as you're diversified, then it should tend to grow over time.
Yeah, thank you for that breakdown. And I think the reason why I love talking about investing so much is because I feel like the UK has become great savers now. Like, everyone loves to save, everyone's got their easy access savings account, and people, I think, are slowly building that habit into saving, but often overlook investing. Why do you think it's important that people actually invest alongside saving?
Yeah, I mean, I think it's a good point about the UK specifically, because I think we're not very good at investing.
Yeah.
I think there's maybe a couple of reasons for that. The education is lacking. I think as you're a big advocate for that, I know. So that lack of education is a factor. Also, I think the property market in the UK is quite tough. So that we sink a lot of our wealth into property, which doesn't really yield anything. So if you buy a house, that is a factor. But I think, sorry, to your question in terms of investing over saving, it's a simple arithmetic really of the rate of return. If you put money into savings account, you can get an interest rate of say 2 to 3% maybe at the moment. It has been a bit higher recently. I think that's one of the reasons people have put a lot of money into cash ISAs. Because they were getting a good return. Now, not so much. So you over time, and I did a bit of research on this for Saxo. There's an article that I published on this, and I can't remember the exact numbers on that, but the value in terms of if you put a certain amount in a cash ISA versus a stocks and shares ISA, and I assumed that you were investing only in the FTSE 100, which has grown over the last few years, but not as much as, say, the American market has, you would be significantly better off. The value of that investment would be much higher than if you just left it in cash. So cash is obviously completely safe, but I've been asked about this by journalists in the past, and there's always this thing of how you have to flip it the other way, which is think, what's the risk of not investing? So investing is risky, but if you're leaving your money in cash, you're losing value potentially over time. So there's a risk in not investing as well.
And I'm glad you mentioned that, because again, people always see investing as risky, but like you said, the risk of not investing is huge. And I guess one benefit of us living in the UK is if we are enrolled into our workplace pension, we are kind of investing, because again, people forget that their pension is actually invested. But I feel like because there is that lock and we can't access that money at a certain amount of time, it is really important to, I guess, build wealth investing in a stocks and shares ISA alongside that. Would you agree?
100%. I think it's I think people maybe struggle a bit to put that extra money aside. So maybe they go into auto enrollment and are happy with that, but to put extra money aside when you know it's locked up, as you say, until you're whatever age it is.
Yeah, it's increasing now, isn't it?
I mean, I'll be 75 before I can retire, I think. But it's hard, especially when cost of living's so high. Inflation is a problem. People's earnings not gone up enough, and so on. All these factors that I'm sure everyone feels don't need to be told. To put that extra money to one side can be a bit of a wrench, whereas a more flexible stocks and shares ISA, which you can take the money out of if you need it, that maybe makes a lot more sense, because actually you can get hold of it if you need it, but you still benefit from that tax wrapper, which means it's not taxed, which is obviously a benefit, and you can hopefully see the value of that investment go up over time as well.
Yeah, I agree. And I guess obviously today we're talking about diversification. Now obviously there's so many different investments we can make as an investor, which I feel like puts people off investing because it can be really overwhelming. But what actually is diversification when investing in the stock market?
So simple terms, it's basically not having all your eggs in one basket. You could have invested all your money into Nvidia 5 years ago, and you'd be, incredibly happy. You'd have made loads of money, and it would have been brilliant. But the risk that you run that whole time, and that one stock could something could go wrong.
Yes.
So the idea is that you spread the risk out. You maybe look at different sectors of the stock market, different companies, different sectors. It's possible to invest in, an index, so the FTSE 100, the FTSE 250, the S&P 500 in the US, where there's obviously lots, and that naturally spreads the risk, because you're exposed to all 100 companies in the FTSE, and it's weighted and so on. So diversification across stocks, but then there's also diversification across asset classes as well. So there are, as I said, there's other asset classes. So bonds, which are, when the government talks about its borrowing figures, and what it's referring to really is bonds that it's issued. It's sold the bonds, you buy the bond, you maybe get a small return on that, or you get the premium at the end. So that's a more classed as a safer asset, but because of the way things have gone lately, we've seen UK bonds actually lose a bit of value over the last few years, the last 3 years in particular. So it's not always as safe as it might appear. And then there's diversification into, say, other asset classes like crypto assets. People are doing that. It's not something that we necessarily promote at Saxo, but it is something that's happening. Let's be honest. And then just going back to the stocks and shares, there's also diversification across regions. So exposure to the US, UK, Europe, emerging markets, Japan. There's a huge array of assets out there, and it's not necessarily about picking the one winner. It's about seeing what the general scope is like, and trying to find a good mix that suits your kind of risk profile.
I think that was beautifully explained, because I feel like, again, it can be really overwhelming, and I feel like in the investing world there's just so many jargon words that you're just like, what the heck does that mean? And so I guess if there's a beginner listening to this podcast episode today, and they're like, okay, after this episode today I'm going to start investing, I need to diversify, but where do I actually start? What would you recommend, or where do you recommend they start when it comes to diversifying that portfolio?
So assuming that you're in the UK, I would start with a UK bias, because I think it's probably the easiest to kind of get your head around, because the companies are known to you, because it's priced in sterling. You're not exposed to currency moves as much. So I would look first of all at the FTSE 100. It's maybe not the most dynamic stock market that we have here. It's chock full of banks, financial stocks, and mining stocks, and Shell, and pharmaceutical companies, tobacco stocks, and all sin stocks are called sometimes. So there's not your Nvidias or your Teslas, but it's a good sweep of the UK market. It's got a lot of exposure to foreign earnings. It's not exposed so much to the UK economy, which can be a bit on and off, as we know. It's got, because it has that global kind of reach, it's quite a good place to start, I think. And so there are funds or ETFs, exchange traded funds, depending on what it is you want. There's a range of these funds available that mean you can invest. You buy a share in all 100 shares effectively.
Yeah. And that's what I kind of preach. Again, not financial advice, guys, but yeah, looking at the index funds, looking at ETFs, because again, you are able to, I guess, invest in a range of different companies without actually having to do too much heavy lifting when it comes to research and, you know, picking individual stocks. And I mean, if you have ever picked individual stocks before and you've been lucky, I mean, share the advice. But yeah, overall, a lot of people do tend to kind of steer towards index funds and ETFs, don't they? So I guess obviously, like I mentioned, people are still often put off with the idea of investing. So what tips or words of encouragement would you share with anyone listening today that still is too scared to take that leap?
I would say just take the first leap. So it doesn't have to be all your savings. You don't have to commit, you know, all your money, but just take an initial leap. So with a small portion, however little you want to start with, it doesn't matter. The key thing is to start, because once you start to get a feel for it, and you start to understand. So just start with as little as you can manage, or as much as you can manage, whatever it is. But it doesn't matter how little it is. Just try and start the process, and start with the most obvious thing that maybe you think of, the stock or the fund or the index or the whatever it is that you sort of understand. So there's a sort of, you know, bit of a saying about you should invest in what you know. Now, I think that's not always true, because actually there's a lot of stuff I don't know, and it does really well. So, I mean, I don't know anything about AI, but it seems to be doing quite well. So I know an awful lot about supermarkets. They're not such a great investment, you know. But for the purposes of starting, try and just start with something simple and small. It's not as scary as it seems. It's really not. And there is an awful lot of support. Once you look, you have to look, because it's not immediately being thrust upon us. There's a lot of good support out there, though, and you know, if retail investment platforms like Saxo, we have a lot of articles and educational materials, as do most of them. So once you start, you open that account. Just get going, basically.
I think I want to echo that, because I feel like the first step is always the hardest, but then once you actually build that habit, just like saving, a lot of people end up getting addicted to investing, because they're like, oh wow, for the most part my investments are doing well, I actually want to invest more, because in 10 years time this could be so much bigger than what it is. And I remember my sister starting investing, and she's like, oh, I can't be bothered and whatever, but now she's seeing that like capital gain, she's like, oh my gosh, Ola, why didn't I start earlier? Would you agree? Absolutely. Yeah, it's a vital thing, I think. You know, and it's important. It's not just sort of numbers on a screen as well. It's people's future. It's your retirement. It's your ability to buy a house, maybe. And when you're investing, you know, in theory anyway, you're putting money into companies that can then generate jobs and productivity and earnings. So the idea, it doesn't always work, because, you know, nothing's perfect, but the idea is that it's quite a virtuous circle where, you know, you put your money into a company, they use that money to grow, to generate jobs and productivity, as I said, and then you get the returns as well. So it should be something that everyone's doing. Yeah, I agree. And I guess, you know, when it comes to obviously investing, we've obviously got the option to invest in a general investment account, or we can open up a stocks and shares ISA. But what are some tax considerations we need to bear in mind when we are looking to invest in the stock market? Yeah, so I mean, in the UK, we've got this quite a simple, quite good system overall in terms of, you know, you can get tax relief. So the stocks and shares ISA is the sort of, I would say, the best place to start, because it's the same as the cash ISA. It's £20,000 limit across the two per year. So you can have both, but the £20,000 limit is the same across the two. So you could split it however you want to, and that means that when you take money out, you're not taxed on that money. So when you invest in a SIP, that money, you get tax relief when you put the money in. But then when you take it out, you assuming you go over the threshold in the year, then you would get taxed. So the ISAs. The stocks and shares ISA is nicely set up to be flexible, that you can take the money out and you're not then getting taxed on that money that you take out. So it remains fully flexible the whole time. Yeah, thank you for sharing that, because again, people often forget that they actually have I guess a mini tax haven in the UK. The tax man is kindly generous in some aspects. I feel like people forget about that, and especially when you are looking to invest in the stock market, people forget that depending on what you're investing in, you might get dividends as well as capital gains, and obviously you want to make sure that every bit of money that you're earning is kept tax free, right?
Yeah, absolutely. I mean, it's if you're got more than £20,000 a year to invest, then fabulous. But you will face some tax on that. You'll the general investing account is you do get tax on that. So yeah, it's protected from all these different taxes. So it remains the best place to start for sure.
Yeah, I agree. And I guess to round off the podcast, Neil, 2026 is very quickly approaching. Do you have any final top tips for anyone looking to start investing in the stock market?
Well, I would say, first of all, we're coming into 2026. We've had quite a good run up since April in terms of the stock market. So, I mean, I'd split the tips into two. There's one which is just start reading, start finding out, open an account.
Yes.
You don't even have to put money in necessarily when you open. You can just open it, download the app from the provider. You can do all that and just get a feel for it. Start thinking about it. Make it top of mind.
Yes.
Do it today, not tomorrow. All that sort of jargony stuff. I mean, it's sort of cliched, but and then in terms of the markets, we've had quite a good run up. There's sort of a lot of chatter about AI being in a bubble, and a lot of the stock market gains over the last few months have been driven by AI. In fact, really, the last 2 to 3 years. So I'd be mindful of what's going on in the broader market, but think long term.
Yeah.
That yes, there will be ups and downs all the time, but don't get afraid. Don't be scared by that, because that's the normal thing. So, but yeah, I'd be looking at the UK. I quite like the UK.
Yeah.
There's a massive valuation discount, so our stocks are about a third cheaper than the US, even when you allow for the different sectors being different. Yeah. So there's a lot of tech in the US that's not here. Strip all that out, we're still about 30% cheaper.
Wow.
And particularly the FTSE 100, it's the companies where they're exposed to, where they generate sales, is very broad, as I said earlier. And there's if you sort of look at just basic things of expected GDP growth plus inflation, which is sort of gives you an idea of what their sales might look like, then they're looking quite positive over the next certainly over the next year. So not a bad place to start, I think. Yeah,
you know what? I'm glad you shared that, because I feel like sometimes being in the UK and being surrounded by so much bad news and bad press, you do feel like you're just, it's doom and gloom everywhere. But you've shared quite a positive outlook on the stock market. So I think that's a great place to start, guys, if you're looking to invest towards the end of this year. But no, Neil, thank you so much for joining me on the podcast today. It's been great chatting to you. And hopefully you guys listening feel a bit more clued up about what it means to actually diversify your portfolio, because again, that can often be a jargon word that throws us all off. But Neil, before I let you go, if anyone wanted to check out the products you guys offer at Saxo, where can they go to look?
Head online, Saxo UK, just type Saxo UK into your browser and you'll find us. We've got the website, there's an investing platform, there's a trader platform if you're looking to trade as well. So, but yeah, so just Saxo UK and you'll find us.
Brilliant. Well, thanks so much, Neil.
Thank you.